the Federal Reserve does plan to hike up those interest rates next month to help the nation's worst inflation in 40 years that is partially due to the pandemic.
News 5's Caroline Peters joining us live this morning with more information on how this could impact us. This isn't a lot of exciting news for folks, Caroline.
Yes, good morning, Bree, Ira. Despite the conflict in Ukraine, the Federal Reserve does plan on sticking with their decision to raise interest rates next month. And it is predicted that that trend will continue through 2023. I did have the chance to speak with a local economics professor here in Colorado Springs who offered insight on how this will battle inflation that we are experiencing right now. He says that we have seen a trend that started before the pandemic. It's Professor Hong from UCCS. He says a big part of the shift was we went from services to goods. We went from people needing to make big purchases like computers to work from home. And during the pandemic, houses had a built up savings, but that savings did run dry. So the personal savings rate was at an all-time high at the start of the pandemic. He says that has changed.
Consumer debt has increased. And so households built up the savings. They were looking a way to spend it. They spent it on goods and services. And when the savings depleted, they went to their credit cards. And so by raising interest rates, it will make the cost of borrowing, again, expensive.
The new rate could influence the rate of car loans, mortgages, and credit cards. Since borrowing a loan will be more expensive, consumers may think twice before taking out a loan. The Federal Reserve plans on raising interest rates during their next meeting on March 16th. That's what we do know. What we don't know is how much they will choose to raise interest rates by, whether it will be by 1/4 of a point or by 1/2 a point to start. In Colorado Springs, Caroline Peters, News 5.